Good evening, everybody. You are very welcome to tonight's webinar with me, Paul Merriman, here with On Post. Thank you very much for taking the time to join me. I'm just going to ask people to show a quick show of hands. There should be a little hand down here on your screen to make sure you can hear me. Okay, you can. Thank you very much. And then I'm just going to get into tonight's presentation. Before I do, I'm going to do this for about a half an hour, 40 minutes. We've got a lot to get through, and we're going to try and leave a bit of time for a Q&A at the end. If you do think of a question as I'm speaking, there's a Q&A box down here. Feel free to put it in. I'm going to be sharing a couple of screens with everybody too, so I will ask you when I do share the screen to again maybe just throw your hand up to know that the screen has shared. I just don't want to be talking without sharing the presentation, which sometimes can happen unfortunately. So just bear me for 1 second. We get into the full screen share and we'll get going. Let's see screen. Great, we should be away again. Yeah, screen, and you have the thumbs up again or the hands up. So thank you very much for that. So guys, like I said, I'm delighted to be here tonight with On Post Money to have a chat through the Money Masterclass. There has been a lot of different economic turbulence, I suppose, over the last 6 months as well. So I think it's great that somebody as strong as On Post, very proud to be associated with On Post, has asked me to get involved in doing a Money Masterclass. So I hope you get some benefit of this and makes an impact. Before we get into talking about all things to do with personal finance, I want to talk about the word financial well-being. And you're going to see the word financial well-being talked about around the world, around nearly every bank and every person that's in finance. And think the word well-being is used way too much. And I don't think, people understand what it means. It's not supposed to be a marketing trick. It's not supposed to help people sell financial products. It's supposed to be whatever it means to you rather than an advisor or a salesperson. So let's look at this. The Consumer and Financial Protection Bureau, the CFPB over in the United States, has defined financial well-being as the following statement. They define it as a state in where you have control over your day-to-day, your month-to-month finances, have the capacity to absorb a financial shock, are on track to meet your financial goals, and have the financial freedom to make choices that allow you to enjoy your life. Nowhere in here does it mention anything about pensions, investments, savings, credit cards, bank accounts. And actually, the most important part of this statement is the last piece, which it says allow the choices to enjoy. Sorry, to make the choices that allow you to enjoy your life. So everybody works really hard. You get a wage into your bank account, or if you're on social welfare payments and you get social welfare payments into the bank account, you're in a situation where you need the money and you have to make the money work as hard as possible for you. But it also has to, if it can, help you enjoy life. There's a fine balance in personal finance about trying to, I suppose, make your money work harder for you, which I'm all up for, using tax relief like a pension, which we're going to discuss later on. But it's really important that people realize it's first and foremost there to probably be spent, and first and foremost there to help you enjoy life. Now, obviously, you have to make sure you have the basics in here, which is the day to day stuff. And the day to day stuff is really, I suppose, the likes of, making sure you get the payday on time, making sure you're paying for the roof over your head, food on the table, heat, and electricity, clothes, etc. And then after that, if you have got money left over, you need to be an adult and decide what we're going to do with that money. Are we going to spend it and blow it all? Great, if that's what you want to do. Or are we going to take a small proportion of that money and help us in the future? And in tonight's presentation, I'm going to show you a few ideas about how to make that smaller bit of money maybe work really hard for you into the future. So I'm really looking forward to bringing you through that, because I do think that's one of the best parts of financial planning, is being able to do that. We did an Ask Paul survey, and that survey, I suppose, as kind of said, 90% of the population are prioritising saving investments for financial success in 2024, with an overwhelming portion of the population optimistic about their financial outlook. Okay, so there's now, in fairness, that's a lot of people. But I think people are concerned about their finance more than ever before, and they're really trying to optimize it and put it into the forefront of their mind when it comes into 2024. And that's really what we're here tonight to discuss. I'm also going to discuss the On Post Money Manager. The reason why I want to discuss this, obviously, I'm here from On Post, and it's one of the amazing things that On Post has. But the reason I like it so much, and I'm not just saying this, I had an account well before I got involved with On Post, is that I think when it comes to personal finance, and you see this when it comes to this piece here, I'll go back a few slides, look at having control over your day-to-day and month-to-month finances. You need to make this as easy as possible for yourself. You need to make this seamless. You need to make it automated. And the on-post money manager does that for you in the background. So you can link all your accounts there. So there's an AIB, a Bank of Ireland, a PTSB, and an on-post current account maybe. You can link them all here. And it literally, as it says in the middle there, budget like a boss. It helps you set up parameters, okay? So you can set and stick to limits, and the money manager will tell you when you reach your limit or when you run out. And I think more often than not, and this happens to us all the time at Ask Paul, we're doing mortgage consultations for our clients. The mortgage consultation, people come in and we ask them to give their statements, and they're shocked at how many pages they have on their statements because you can tap your money with your card, with your phone, with your watch these days. You can just get rid of money so easy. So it's easy to overspend. And I think back in the day, like I thought back in the day when I was a kid, everyone used cash and it was much easier to budget because when you went to your wallet and your purse and your money was gone, or it was the last 20 you had, the last 50, you'd kind of rein in the spending, obviously, because it'd be gone. Where I think online now, it's so easy to overspend and not have those controls in place. So I think the money manager really does a great job of doing that for you. It keeps everything intact. And it's like having a little PA for your money in the background, looking after your money. Now, obviously, you can overrule the PA and keep spending, but you're hoping the PA from the money manager is going to give you a good shout to say you're close to this, or you're going to miss direct debits. And this is another one that can have a massive impact on people, especially when they're going for mortgages. If you're missing car loans or credit card payments, or even just missing unpaid direct debits, it's the first thing the bank will look for, and they hate seeing this in your accounts. So again, with current technology and being so easy to lose money or spend money, it's so important that if you're not good at managing your own money, just let the on-post money manager do it for you. It's free. You download it. You can link all your different accounts to it. You don't even have to have an on-post current account. So again, like I said, I don't mind promoting this because it's free, and the fact you don't even have to have an on-post account. It's just a really cool tool to help you with your finances. And this is the first step when it comes to financial planning. It's like the foundation. There's no point in having a pension, an investment account, thinking you're really clever, and then, you can't get the payday without being in an overdraft and missing direct debits, because that just brings too much stress. And the one thing about having a financial plan is it's supposed to bring you peace of mind. It's supposed to help you be able to enjoy your money, not to be stressed about it. And look, this does it. And I'm genuinely, I always find it difficult. Sorry, I've been in the financial planning services business for 20 years. We've had our own business for 12 years, and we've never teamed up with another company. So when Post asked me to do this, I was delighted to team up with them, just purely because, I've known Post since I was a kid. It's a very trusted brand for me personally, but also I do believe in the money manager, and I do think it really helps people. So I don't mind promoting it for that basis alone. When it comes to personal financial planning, you're going to see this wheel here. So this wheel is the first personal financial wheel that we developed at Ask Paul. The wheel goes from, if you like, clockwise right the way around. So it's going to start with personal budget and emergency fund, then go on to no short-term debt, or little or no short-term debts, then into protection products like income protection, the most important product you can have, savings and investments, mortgages, pensions, and tax. The idea behind this wheel is you're supposed to score yourself at all aspects of the wheel, 0 to 10. Okay. Now, the concept behind here is that wherever you're the lowest, you focus your attention on, you try and make it better. Okay. Now, psychologists and psychotherapists do this all the time, what's called the wheel of life. And they'll ask you to score your relationships with your spouse, your kids, your partner, your parents, your work colleagues, how much time you spend with everybody, and hobbies and work. And the idea is that when you do that from a personal life point of view, if you're completely over indexing and working, you're not spending enough time at home, you might really shift that balance. It's the same here with the financial wheel. We want you to identify where you think you may be underperforming or not spending enough time concentrating on. And then you tackle that first, and hope you tackle that heavily in 2024 if you can. But the financial wheel is actually not supposed to be sorted today. I always give this example when I'm doing corporate talks. I'm 41 years of age. I don't have my pension 10 out of 10. I'd give it a 5 out of 10. But I've another 20 years to sort it out. Now I'm on track to sorting it out because I'm putting something in place that will get me there. Your mortgage, you're going to have a big mortgage in your probably 30s, 40s, if not 50s, and then you're supposed to get the mortgage down to zero before you get to retirement age, or maybe 70. So again, these are all going to move, and this kind of little clip here shows you the financial wheel moves, and it goes from 0 to 10, or 10 down to zero throughout your life. So if you're someone that's watching this evening and you haven't got something sorted, this isn't to make you feel bad. It's just to let you highlight it and see, can you sort it out in the next couple of years for yourself? And that's so, so important that you try and do that. So like I said, don't feel bad if you haven't got 10 out of 10 on any of these, but try and see can you move yourself towards getting to a 10 out of 10 at some stage in the not so distant future. And again, it's supposed to give you something to maybe just keep an eye on into the future and think about. When it comes to financial plans, it's really, really important that you consider three main components of your financial plan, and that's to protect, grow, and replace what you have. Okay. And when I mean what you have, I mean your income. It's really important. I mentioned earlier on income protection quickly. Income protection, without a shadow of a doubt, is the most important financial plan you can possibly have. It's more important than a pension, an investment account, anything else. And the reason being is that if something goes wrong, like an accident or an illness, and you can't work, income protection pays you a percent of your salary up until you get to retirement age of 60, 65, or 70 years of age. It's really important if you have a mortgage and you have kids or you're self-employed, it's particularly important. And if you're on a substantial income, like anything in the higher, any kind of income, above maybe 50 and 20,000 euro, it's important you have a plan in place because the only thing you will have as a PAYE worker is the government illness benefit, and it's about 12 to 13 grand a year. That won't cover the majority of people's rent or mortgage. And as good as employers would be, employers are not going to keep it on the payroll for the long term due to that sickness or illness. So it's really important that you understand that income protection, it's a product, it's cheap enough, you get tax relief on it as well. If you need advice on this, right, that we're going to talk today, just please reach out to us on any of the Ask Paul social media challenge channels, and we'll be able to have a chat with you. But yeah, it's so important. So you protect what you have. Now, protection can also be like a life assurance. It can be mortgage protection if you have a mortgage. If you're someone that's run up a lot of debts, you might want to have extra life cover. So if you do pass away, your debts will be cleared. So protecting everything is really important, and especially if you're self-employed and you have kids or you have kids and a PAYE worker. Growing your income then is all about making sure you can grow the income that comes into your household if you don't need access to it. So if you don't need access to your money for maybe 5 years, if you're looking enough not to need access to €100 a week or 200 quid a month or 500 quid or 1,000 a month, whatever your situation is, you should be investing that money. And the reason is that across the board in Ireland, most places where you hold your money are given really low returns, or typically speaking under 1 or 1.5% in the majority of places. When that happens and inflation's 2.5 or 8% as it been in the past, your money is devaluing. Now you have to give up with this devaluing if you need, say, you have a deposit together for a house next year, or you have a lump sum to go on a holiday next year, you're going to buy a car for cash. You can't invest that money. And I'll talk about this later on. When it comes to investing, you need to leave your money away for at least 5 years. So just take that into consideration as we're talking through this. And then replace is we want to replace your income when you get to retirement age and you're retiring and you don't want to work anymore. And that's the most obvious thing for us all to try and strive towards, I suppose. But again, I mentioned the word balance earlier on. It's really important you have a balance in your financial plan. And what I mean by that is, if you're in your 20s and 30s, very small amount of money, if anything, going to a pension, unless you have a company pension plan where you and your employer are paying in. But there's no real point in putting money aside for 65-year-old you if the kind of now is a little bit all over the place. So I'd only recommend funding pensions when most of the other aspects in the financial wheel I showed you earlier on are somewhat under control. So that's the main things. Always remember that protect, grow, and replace, the three most important words when it comes to financial well-being. Now, also in financial well-being, the main thing you want to be considered about is your goals. So what I'd like you all to do now is just take a couple of seconds, take your phone out, take your notes out on your phone if you have an iPhone, or text yourself or email yourself. I'd like everybody on the Zoom tonight to write down three financial goals that you have. So most of those financial goals I find from clients are getting the property ladder, get rid of my mortgage before I retire early, go on job share, give up work, or take a career break, set kids' education funds up for the kids, maybe put an inheritance tax in place, inheritance tax financial plan in place if you're receiving money off your parents, or if you think you're going to be giving money down to your kids, to make sure the revenue commissioners don't take too much of it on you with inheritance tax. And they're typically the big things that we see when people want to come to financial goals that they fill in for us. But I think it's important you write down your own financial goals today and try and just think about today after tonight's session. When we stop this, before 9 o'clock, just click in and say, click into gear and look at your financial goals and think to yourself, am I on track to be on where I want to be with these financial goals or not? If you're not, reach out and get a consultation, be it with us or somebody else, but get a consultation with a financial planner. A good financial planner is not supposed to sell you a product. They're supposed to find out what's important to you, how are you on track to meeting those financial goals, And then if you're not on track and you want to retire early for argument's sake, well then yeah, a pension product might be needed, but it's not there to sell you a product. So it's really important that you try and get to a financial planner that you trust, that you can bring your goals to and say, this is what I want, this is where I am, how do I get there? And believe it or not, you might know how to get there. You might think you know how to get there, but we might give you another idea, or we might give you something that looks at a better investment opportunity, or again, using tax relief from the revenue commissioners might really fuel it or make sure you get there 5 years early. So don't necessarily knock it. And I think sometimes financial planners can get a bad rep as product salespeople. Unfortunately, there's a lot of those in the industry. But yeah, you want a financial planner that's going to help you get your financial goals by keeping these three main components in place: protect, grow, replace. Moving on from that, we mentioned the protect piece. From a grow piece, we mentioned this already. The main thing I want to go through here for people is that before you actually even look at the growing your income as an investing, you need to look at these three things. Okay. Before you invest any money for 5 years plus and lock it away, you need to make sure you clear your short-term debt or you're on top of it. So if you've got a personal loan and a car loan, and the car loan's costing you, say, 8%, there's no point in me setting an investment account up for you that might get 6%. Clearly, it'd be better bang for your buck to overpay your car loan and clear it early because you just saved yourself 8%. So again, sometimes in financial planning, when you come to a financial planner, it might be, okay, this is what you need to fix. And then next year, 6 months' time, 2 months' time, 3 months' time, we can do all the cool stuff. But you have a little bit of tidying up, or here's how you can utilize your money the best. And that's so important. The next thing you need to make sure is that you have an emergency fund. Now, an emergency fund can be as little as €1,000 in a non-post account. If you're self-employed, I think it needs to be much higher, typically 3 months' expenses. Because if you're self-employed or your partner or spouse is self-employed and something goes wrong, even economic-wise, work-wise, contract-wise, someone not paying them, or they, God forbid, get sick or have an illness or an accident, they need an emergency fund to cover probably the next 2 to 3 months while they try and sort things out. You're lucky if you have a good employer and something goes wrong, you're probably going to get a couple of weeks or a couple of months of grace, and it's really important. Again, if you're renting, your landlord will probably still want the rent every week or every month. Where if you have a mortgage, you can negotiate with the mortgage company to put you on interest only or moratorium while things get back to normal. And this is why financial planning is so different to everybody. It's not never a one size fits all. I don't know all of you guys, a few hundred people on here nearly. I don't know all of you guys. I don't know your situation, your age profile, your family, your income tax, your income, your past experience with money, your past experience in investing. I don't know enough about you to be able to give you, I suppose, a definite financial plan tonight. So what I'm trying to do is give you things to think about and provoke thought for yourself going forward. And that's why I'm saying with the emergency fund, anywhere from a minimum of €1,000, maybe up to 10 or 15 or 20K. And the financial plan that would be assessed. And then we do that first, then move on to the investing. The short-term cash requirements, I mentioned this earlier on. If you're someone that's lucky enough to have a lump sum for a house next year, or go on a big holiday, or getting married, or whatever the big things in life are for you, it's important that you keep that cash in cash. You have to just suffer for the short term, for the low deposit returns, because you can't invest. Because typically speaking, when you invest over a 5 year period, and these are most 5 year periods, or on average more than 50% of the 5 year period since the 1920s, you're going to have 2 years that are negative and 3 years that are positive. So if you've got 2 negative years in a row next year, you don't want your house deposit decreasing, because that might mean you won't get a house or getting the property ladder. So that's same for the wedding. You might have less to spend the wedding, or whatever else you do in your life. So it is important you have those three things considered before you invest. If you have all those nailed, then knock yourself out and start investing, because you need to beat inflation. And inflation is the most important thing you could possibly have. We have this financial planner, and that's going to help everybody assess where they're coming from an income point of view. And I think this is so important for everyone to do. You can download these on Google, so I'm not trying to push. It's free. Again, we have them for free for our clients. Happy to give it to you guys if you want. So sign up on askpaul.ie. And this is where you're going to put in all your income and expenses and the budget. Now, if you do this for yourself first, and then you go to the on-post money manager to be able to put in your actual, sign up all your accounts to it and track your money, you're on to a really good start. And this is the basis or the foundation of a good financial plan. So I encourage you all to do this as well. And this just tracks what's coming in and going out in your head and maps it out so you can see it. And then it's important you make the decisions from then on what you're going to do with it. For those that mightn't be able to invest just yet, because you might have a bit of short-term credit card debt, you might have, which again, coincidentally enough, I'd recommend, if you're not with on post, switching your credit card to on post for at 0% period of time where you can clear more capital off your credit card. But in this example, we're going to show saving challenges. We've three saving challenges here, that's Paul. We do these every year. So you've got the beginners, the intermediate, and the advanced. Everyone that's on the Zoom tonight can do this. You can start on the beginners. It's €1 you need to put aside this week, €2 the following week, €3 the following week, four the following, five the following. So you see what I'm doing? I'm increasing by €1 a week. So, week one's easy, two is easy, three might be easy. It might get a little more difficult as you get to week 10, 15, 26, whatever that is for you. The idea is that during the challenge, it is called a challenge. During the challenge, you change your spending habits. So you might not take a coffee to work every day. You might make it at home. You might not take your lunch. You might make it at home. You might skip one night out a month. Whatever it is that helps you get the money into the account. And by the end of that period of time, you're going to have 1,370 euro at the end of a 12-month term or 52-week term. So it's a really good way. If a couple do this, it's 2.5 grand. So it might be a nice way to start a clearing down credit card debt or short-term debt, or to start a little savings for a holiday or a house or a wedding or whatever it is. Going on to the advance or the intermediate, you see it's €5,000 and the advance is €8,000. These are much bigger amounts, obviously. You start with €20 in week one, 35, 45, and these are redesigned for payment that might be paid monthly. A big lump sum then in week 4, week 8, week 12, week 16, etc. I won't go through all of them. I'll be here all night, but you can get the gist of what we're trying to do here. Now, look, loads of people have said to me, Paul, if I want to save 5 grand, I'll just avoid the 52 weeks, evenly, and put in just under 100 quid. That's sometimes for people, they need a challenge and they need to feel motivated. So a lot of our clients will print these off, put them on the fridge, put them in the mirror in the bathroom, transfer the money maybe into one of the jars. And if you have an on-post account, which is really good for doing that type of stuff, if you're moving into one of the jars, every day, you tick it off your list every week on a Saturday or Sunday. It's just motivating. Other people do it in reverse. So for the beginner's challenge, they might start at €52 this week and then do the hardest week first, and then it gets easier. So when it gets towards Christmas, you're only saving 1 or 2 quid to complete the challenge. And other people just spontaneously pick a number. The last one, the kids, they pick a number between 1 and 52. Whatever that number lands on, they save that money into their jar. So there's loads of ways to do it, but it's just to keep it interesting and try and keep it, I suppose, like a challenge. I think a lot of people like a challenge, especially at this time of the year when it comes to January. So I hope that works. Going forward then, sorry for a second. Mention this as well. The main reason you need to invest is to actually be able to beat inflation. This is a Freddo bar, one of my favorite bars, I'll have you know. The Freddo bar going back to 2000. I remember the good old days of 2000. And before that, when the Freddo bar was typically 10p or 10 cents. Obviously, we've taken this from an English slide. But if you look at this, what's happened from 2000 all the way up to, say, 2020 even, the Freddo bar has gone up to 17p, it's 27p. If it had gone up with normal inflation, which was average 2.33, it would have went up, to 17p. But Freddo's went up higher. They went up at 4.36%. Now, why am I using this example? Let's say you went to the shop as a kid in 2000 and you had £1 or €1. You would have bought 10 Freddo bars and you would have been delighted with yourself. Bit sick, but you would have been delighted. Come back 10 years later, and Freddo bars were 27p, you would have got just under 4 bars. And that's the impact of inflation on something as simple as €1 and a Freddo bar. And if you look at it, if you have money and you're looking at the likes of health insurance going up more, the likes of house prices are going up more, you're trying to get on the property ladder, the likes of car insurance is going up more, bread and milk are going up more. So this average of 2.3 or 8% you talk about with the European Central Bank, they're usually there as what's an average basket of goods sometimes. But depending on what you want in your life, you might be looking at something that's grown by 10% per year. So again, if your money's sitting in the bank and 0%, and you haven't invested and it's not growing, you're doing yourself out of money. So it's really, really important to note that the main reason to do the investing is to beat inflation, not to be a millionaire, become rich. Sure, that might happen if you invest for long enough. But typically speaking, we want our clients using their investment accounts during their life, not just letting them sit there to become a millionaire at 30. You need your investment account to fund your life, and if it's being used properly. Here's an example of a couple of slides. Here's an example, sorry, of 3 funds rather. That looks at €250 invested since 1990. Okay, so 10 years before the Freddo bar. So if you went back to 1990, and let's just take 3 people on this Zoom tonight, and one person invested in an account with 3% per annum, one invested at 6%, and one invested at 9%. The one at 3% has now got 173,000, where the one at 9% has got 590,000. Now, these are excluding taxes and charges. But put into a pension plan, you wouldn't have tax anyway on the growth, so you'd be fine. To give you an example, but look at the 590k. They're three people put the exact same €250, but yet one person, has a considerable amount more. Now, if you're a couple and you're putting 500 quid in, or you're a good enough salary, about 500 quid in a month, it's over 1 million, obviously. So that is quite good. The difference here between the 3, 6, and 9 is, typically speaking, where the money is invested. You can invest your money in a number of different asset classes. So you can invest it in equities, in the top right, top left, then bonds, underneath that, alternatives, or cash. I think you should only have money in the bottom right hand corner with deposit accounts or called accounts or foreign exchange, not even foreign, wouldn't touch foreign exchange, but typically deposit accounts or bank accounts with 0% interest if you need access to the money over the next 5 years. So again, we mentioned this already. You don't invest that money if it's under 5 years. Once it's over 5 years, you kind of want to be going towards equities. Now, equities are stocks and shares. And now people get scared by the word stocks and shares. They probably think of the Wall Street film, or, guys in big suits and loads of money trading and what. It's not that anymore. Trading's become so easily to do. There's loads of different apps, loads of companies that bring really good investment solutions to clients. We, like here at Ask Paul, we manage over 330 odd million for our clients. We've got clients investing €100 a month, and clients investing millions that might have sold their company, or they did really well over life. So there's a wide range of, you don't need to be a millionaire, have a six-figure salary to invest. Everybody can invest. And typically speaking, for us, we usually look at that minimum €100 on some of the contracts we use. Bonds, corporate bonds, government bonds, that's basically where you give an IOU. You give money to the government or to a company, and they give you back your money with a little bit of interest every year over a set period of time. And then down the bottom, we had a bit of a love affair here in Ireland in 2007 with the property. And you see commodities, absolute return funds, and maybe like a cryptocurrency in there too, in the alternative basket now. But it's really important that you need to find the right mix of where to invest. Equities are usually the best performing asset class. So if I go back here, that 590 to me is someone that's 100% in equities, which is okay depending on your time and your age profile. If I go back here, somebody with a bit of cash and bonds, or maybe a bit of a back in alternatives, or a mixture of all four of these, we're probably getting the 6% per annum. And somebody at 3 has too much in bonds and cash for my liking. That's where you're probably going to see that 3. So people often talk about risk on these as well, saying that in this account here, the 590 account at top is more risk. And yeah, and the line is probably a bit misleading. It's not going to just go clear like this. It's going to go up and down over the long term, to be fair, okay? When you talk about risk, we talk about risk and volatility. We talk about how much your money will move in the short term. But typically speaking, again, if you're going back to 1920 and you track all these assets all the time, right the way up, and look at a kind of 10 or a 20-year time frame, the best performing asset classes, I think, is 90 odd percent of the time is going to be equities, if not slightly more than 90%, to be honest. So therefore, if we're investing for the long time, we should be okay with equities. And yes, it will move up and down in value in the short term, but over the long term, you should do okay. Less with cash and bonds. So, someone said to me, oh, the cash and bonds is lower risk, Paul. It's only 3%, but I'm still making good money. Yeah, if inflation's 3%, you've gone nowhere. You got 3% in your investment account, charges as well on top of that, maybe. You've gone nowhere, as you might as well have been in the deposit account. So, just be very, very careful about the level of what you're looking to do from an investment point of view. Where can you put your money? From a safety point of view, on the right hand side, we have the credit union, on post money, the state savings as well. State savings are pretty low return, but again, they're government guaranteed. People like them for 5 and 10-year bonds sometimes. We have online apps, Revolut, N26, trading accounts. You can put your money as well in the likes of, obviously, the Irish banks. And not a big fan of those, to be fair. But then you also want to be able to invest your money. So where can you invest? So stockbrokers, biggest in Orange, you're looking at is Goodbody, Davies, Cantor, Quilter. You probably know all these names. Banks, AIB. Wouldn't invest through a bank. The charge and structure through the banks are absolutely horrendous. I would not be investing through the banks. Online platforms like Revolut, Raise, and DeGiro, eToro, they're all quite good, low management charges. The problem with them is you do your own tax returns, but you can also find yourself, in my opinion, in a little bit of difficulty with direct trading. I'm in the business 20 years. I don't even use direct trading accounts. I just, number one, don't have time to keep an eye on them. And number two, I'm probably gonna be one of those people that might think I'm more clever than I am and try and pick a company or pick a stock almost like I'm on a Paddy Power app. And I think a lot of people that experience raising or Revolut, sorry, and trading with the eToro and the Shorter will probably be honest and say the same. There's a big one in the States. I forget the name. Robin Hood. I'm thinking my second name, Merriman there. That always reminds me of Merriman, Robin Hood. But anyway, the Robin Hood app, I think it's over 76% of retail investors that use it lose money. Okay. And the reason being is not that the funds have lost money or the companies they're investing in is bad. It's that they're making the wrong decision because they're not investment managers or they're not trained in investing. I'll always use the life companies. I currently use Zurich for a lot of my business and Aviva. Uh, the Sun performance in Zurich have been phenomenal. If you look at this is a stock market over the last 5 years. You see back in 2000 when everyone thought the world was ending with the pandemic, and it was pretty scary back then. Funds were only down from, I think that's what, May, February, right the way through to July, and it will start back beating markets and it'll be a phenomenal year for stocks and shares. And so it's really, really important, that you understand how markets work and they do go up and down in value. Back to the Zurich account, from a Zurich point of view, I use a fund that's been around for 32 years, has an average return of over 10% per annum for the last 33 years, actually. It was designed in 1989. You can invest from as little as €100 per month. Phenomenal for pension funding or just investments, children's allowance, that type of stuff, for a long period of time, more than 5 years. A really good account. I have a lot of trust in them. They've been around for a foreseeable, for a considerable amount of time. And the performance of these funds have been absolutely phenomenal. Now, past performance are reliable to future growth. What clients do, I won't lie, like to see how well funds have performed and how long they perform well for. So something that has 33 or 34 years of a really strong performance, over 10% on average per annum, is a phenomenal fund for me. Now, in 2007, that fund would have been down 38%. Next 2 years later, it was up to 41%. So, and then it had a massive rally like the stock market has had over the last 10 or 12 years. So, yeah, it's really important that, you realize that there's really good managed funds. And I like it because the fund manager, I think there's 2.3 billion in the fund. They wake up with a big research team and they manage all this money on a monthly basis. I think it's 180,000 there at the moment, and with clients of millions in there, etc. And clients putting €100 a month, like I said. So it's very good that they manage that and they wake up and manage on a daily basis. Where I think if you have your own managing account, unless you're retired and you're an investment specialist, you're not going to know when to make the moves or when to get out of the moves. And I give you an example. Back in 2020, a lot of people are taking Revolut accounts and investing in the likes of Netflix, or Peloton was the big one. The bike, you get it to your house, a few grand, you sign into programs, you cycle in the house. Anyway, spin class in your house, basically. Everyone was loving them because in lockdown, everyone was buying these things and the share price and the buzz around them was phenomenal. But then they all fell dramatically back in 2022. And nobody that had them in the Revoluters, or practically no one knew how to get out or when to get out and what tax was due. And it was just a little bit of a mess for the majority of people I've come across that use that tactic. So, um, why would you do that when you have a fund manager managing a few billion that's going to do it for you? Pick the easy way and find the fund as like a run sale for investing. Been doing it for years and being successful at it, and start putting in, like I said, from €100 up, depending on your financial situation. When it comes to retirement age, we talk about replace. This is something I say to my clients all the time. You need money to retire, not age. And so there's no point in getting to 65 and saying I'm going to retire because I'm 65 if you have no money. You need something in place. And we ask our clients when they're retiring to think about these things, when you're thinking about retirement, or when you're close to retirement, usually when you're mid-50s, start thinking about these things. Are you going to use your house to downsize and release equity? Are you going to use inheritance? Are you going to have inheritance from your own parents or your grandparents before you, or your aunties or uncles? Are you going to give it a large estate down to your kids? And what's the tax man going to do with it? What income tax are you going to be paying? 40%, 20%, a mixture of both. Up over 65 years of age, a couple can bring in 36 grand a year tax free. It's important in consideration. Are you going to live to 100 years of age? I mean, a lot of people live to 100 years of age now, more so than they did 20 years ago. And I think a lot more will in the future too. Are you going to use the fair deal schemes if you get into sickness or injury, from a nursing home point of view, when you're maybe your 60, 70s or 80s? Are you going to use your own house for the fair deal scheme, and how do you prep for that? Are you going to have grandkids? Are they going to be living in Ireland? Or you're going to be living abroad. If abroad, you're going to have to travel more. Zoom is great, but you have nothing like holding your grandkids or your kids. Single house income, are you going to be married in a partnership with somebody, or you're going to be on your own? And if you're going to be on your own, you really have to plan a little bit clever because you only have one income should something go wrong. And it's harder, obviously, to plan on one income. Are you going to like holidays? Are you going to sit in your rocking chair at home in retirement? Cool if you are. You might be a bit of a scholar and just want to sit home and read books all day. That's brilliant. Knock yourself out. Or do you want to plan and travel the world? That will require assets and money. Are you going to be mortgage free at 60, 65? Are you going to be mortgage up to 70? No harm if you are. You might use your tax free lump sum from your pension to clear your mortgage if you know how to do that. And then one thing to be considered for females on the call tonight, we talk about the pension pay gap all the time, or the pay gender pay gap for females all the time, and rightly so. But there's also a pension pay gap because typically speaking, women will take more time off work during their working careers to look after kids or any sick relatives they may have compared to their male counterparts. So it's important that you have a keep an eye on that as a woman to make sure that you have topping your pension up maybe in later years or earlier years when you're young and you're in work and you're not married, you don't have kids. If you're planning to have kids in the next few years, maybe start making a few little ABCs to make up for the gap if you're going to take a year off work or extend your time off work for unpaid leave. So these are all the things you need to be considering usually when it comes to retirement age. And again, I can't stress that enough for you. This is how tax relief works in a pension. A pension plan is single-handed the biggest way to build wealth. Not for everybody at all stages of life. So it depends on where you are in your financial plan, whether you need a pension or not. Now, obviously, the younger you get a pension, the better. If you can start funding something at 20 and you have 45 years to watch it grow, it's going to be better than the person that starts at 40 who only has 25 years to grow. And especially with compound interest coming into place and tax relief. But typically speaking, people get confused about tax relief piece. So every time you make €100, you can make a €10 contribution whenever you want, but using 100 as an example. If you put €100 in and you're on the lower rate of income tax, lower rate of income tax is typically if you earn less than €42,000 this year. If that's you, you're going to get €20 relief back from the revenue commissioners. If you're on the higher rate of income tax, earning over €42,000, you're going to get €40 back for every €100 you put in. And just let this sink in for a second. Take it, just reverse it the other way. Say you give me €60 and I give you back €100. That's a 66% return. Now, mention the fund they're using, the Zurich fund, does 10% a year in the last 30 years. And I think that's a phenomenal growth story. There is nothing as attractive in this country, or probably throughout the European Union, as the Irish revenues tax relief when it comes to pension. It's buckets of free money. Now, obviously, the catch is you can't touch it till you're 60. And that's where the balance in the financial plan comes into place. But if you have an old company pension plan, you work for somebody else, that can be accessed from 50 if you've left service. So if you work for, I worked in Irish Life years ago. When I reach 50 and 41 or 49, I can access that pension plan at 50 rather. And 41, when I get to 59 years time, I can access that pension from Irish Life, which is great if I wanted to. Now I won't need to, but I have to access it before 75 under pension legislation rules. Now, if I had a really high mortgage or even a really small mortgage that I wanted to pay off, well, then I might look at taking some of the money out of 50, clearing the mortgage, taking the mortgage repayment, and then recycling it into a pension with tax relief. So there's some really cool things you can do once again you know how. So I think that's really important to know and to understand, to be fair, because it's just the kind of basics of finance. But like I said, if you haven't got a pension, don't be sweating about it. Don't be worrying about it today. And this is not being talked about as if to make you feel, oh, I don't have this, I have to get it done. It is make you feel maybe reach out and get a consultation, whether it's with us or somebody else, and have a chat about these things in more depth. I'm hoping I'm giving a bit of financial wellness here and giving an overall helicopter view with all these things you need to be doing. Some of you might have them all nailed, some of you might have 2 out of 3 done, whatever your situation is. But it's very difficult to give an overall do these 10 things. It's actually easy, but it'd be misleading. If I was to give you these 10 things and not knowing your income, your age, your background, and you have kids, your family, all these things, it's just misleading. So I'm trying to just to dive into all these different elements to give you things to consider and find out do they fit into your life or not from where you are. Lastly, from a tax point of view, what I'd say on tax, I'd encourage everybody to do this. Go on to revenue.ie and go into my account, and you can go back and claim back up to 20% on any medical expenses for last year. Never done this before, you can go back 4 years. And you can make expenses for you, your parents, if you're paying your parents' subscriptions for argument's sake, or your kids, or your spouse, or your partner. The likes of IVF and non-routine dental treatments. There's a lot of things in there under what's called a Med 1. If you're confused, go into the revenue, my account, and in the search bar, put in Med 1, MED1, and that will show you all the expenses you can get from a revenue point of view. The next thing I want you to do is go to the Deloitte tax calculator. So Deloitte.ie. If you get to excuse me, if you get to the Deloitte tax calculator, you're going to fill it in with your married, single, your employee, what your salary is, and it will tell you what your income tax and your PRSI and your levy should be. Make sure that matches your payslip. That's your proof of record from your employer, what they've paid you, and your employer takes all your taxes at sort. Maybe something's wrong. Maybe you haven't got the right tax credit. So make sure you match up the Deloitte tax calculator to your payslip. If you have an issue, give your payroll department a ring and talk about it. Next of all, what we would discuss in financial planning is, CGT and CAT. CGT is capital gains tax. If you have employee share schemes, you're going to have to pay CGT on selling those and getting access to your shares when they vest. If you have a second property and you sell it, CGT on the growth. So CGT is only on the growth of certain assets. CAT is quite brutal. It's inheritance tax. It's called capital acquisition tax. And it's really important that if you think you have an estate to pass down or you're going to receive an estate, that you try and put an inheritance tax plan in place, because it's too late after the person's passed away to do anything about the plan. You need to do it, and the younger you do it, the better. So if you have a young family, you have a house, if kids maybe less than 5 or 6, and you only plan to have 2 or 3 kids, it's a good chance your family home is going to be worth more than the thresholds. And the thresholds are typically speaking for a child received from a parent is up to 335,000 over the lifetime. So if you have a house in Dublin somewhere, there's a good chance it's probably worth over 500,000 at this stage. And if it is, you've only got one child, they're going to have a capital acquisition tax bill sooner or later, in my opinion. So it's really important you can then speak to somebody about the capital acquisition tax and what you should be doing, or shouldn't be doing maybe as well, when it comes to planning those things. So lastly, before we finish up, I just wanted to talk about mortgages. Mortgages are so important, especially with the current economic situation with interest rates. So at the moment, what's happened is the European Central Bank has rapidly increased the European Central Bank rate to keep inflation down. So what they do here is they suck money out of the economy by increasing mortgage rates or interest rates. Typically speaking, if you're on a tracker rate, you've got a few £100 less probably to spend in the local community or in the economy, and that means the heated economy comes down, inflation falls. They've done a good job. Inflation's fallen quite rapidly. It's just under 3% now, and it was up towards 10%. Now, what happens here is the European Central Bank wants to keep rates at inflation about 2%. In order to keep inflation at 2%, you'd want to have the mortgage rate higher than that to suppress the inflation rate. So this is inflation, this is the mortgage rate. Mortgage rate comes in, it will always be higher to keep inflation down. The fear would be is that if you bring the mortgage rate under inflation, people have too much money, they'll spend more money, and inflation gets out of control again. The European Bank's only rule, and the only job, is to keep inflation down. So I think they're going to settle the European Central Bank rate at about 2.5 to 3%. When this rate was zero, Irish banks were charging an average of 2.8%, and they had a bit of competition rules for banking KBC, who are now gone. So I think you're looking at rates realistically for a tracker holder, depending on what your tracker is in between 2, 3, 3 and 4 maybe. If you've got a really high tracker, it could be more expensive. If you're on a fixed rate or a variable rate, I think you're going to see a bit of pain this year. I think you're going to see rates being passed on. It's really important that when you're going for a mortgage consultation, we do mortgage consultation here at Ask Paul if you want this, or go to someone, whoever you trust. But it's really important that you have somebody that can explain how the mortgage works. It's single-handed the biggest interest you're ever going to pay in your life. And the most amount of money you're ever going to pay to a bank is leaking interest through a mortgage. So please, please, please make sure you have it under control. If you have a mortgage and you're interested in switching or getting to know a little bit more about it, please do give us a shout for a mortgage consultation. We can bring you through everything you know. It doesn't even mean you have to switch. We just bring you in for the consultation and show you, teach you what you shouldn't be doing, and keep an eye on it. So a situation where people should be usually asking, should I be overpaying for my mortgage, etc. And it depends again on the overall circumstances. Guys, I suppose that's our regulatory warnings. I know I flew through this, but I do want to get to Q&As. If you have got any questions and we don't get them tonight, I apologise in advance. There's loads in already. Questions at askpaul.ie, mention on post in the subject line, and we'll get your question over the next couple of days, and we can do that for you. Also, I will say before I get into the Q&A, Today, you just caught me on a good day where we've published a book. So Money Made Easy is on good stores from today, Easton's Book Station, etc., around the country. Everything, including the financial wheel and everything that we discussed tonight in a much kind of more in depth, is in this book. Like I said, you can find it on Eason's online or any of the places. If you are interested, pick up the book if you're interested in personal finance and trying to continue. But equally, if you have any questions, free to ask a question. So if I don't get it tonight, send us in an email or a DM. If you follow us on any of the social media channels, we can have a chat through there for a DM. So we'll go for a few questions. Paul, I received a large inheritance lump sum into my current account, but don't know what to do with it. Future mortgage deposits split into emergency fund, holiday savings. So basically, everything you've just said. Really good question. You're trying to make that large inheritance, sort everything. Definitely put a bit aside into an emergency fund, another bit of cash for a future deposit, depending on your age. I'm not sure whether you have a pension plan. You might put a little bit of money into pension and get tax relief back. Really good idea to do. And make sure you have no short-term debt and short-term cash requirements, but you really need a financial plan to understand your income and what your future goals are. You've done a really good job of describing what you should do, but I'd love to be able to show you what to really do from a really cool financial planning point of view. So I'd recommend that. Okay, is the money manager on my phone safe if my phone is stolen or hacked? Okay, so look, I don't work for Post, just to say, and I'm not the best technical person in the room to ask that question, but I'm pretty confident the answer is yes, and that Post would never be able to launch a product into the market that hadn't got the utmost security. The amount of testing and the amount of legislation to go through to launch something like this in the market is quite scary. So it will always be password protected as well. So providing you don't have your password on your phone somewhere, I'm going to tell you you're pretty good. For financial wheel, where do you land if already retired or just on pension and receive a lump sum? Yeah, so look, you're probably 10 out of 10 in most cases. No short-term debt. The mortgage should be paid already. Your financial life might be just to spend your money and enjoy yourself. And that's okay. When we get to retirement age for people, we always talk about, spending. A spending plan. You're lucky enough at that age, you need a spending plan. And a spending plan means when to spend money without impacting the pension too big, or making sure you're taking the right amount of the pension down and paying the right amount of income tax on it. So that's really what you should be doing. Can you explain how an endowment tracker mortgage works? Well, it's just it's just an endowment mortgage where you have a policy to pay off a lump sum in the future. You really need a lot of advice on that, Deirdre, and a lot of those endowments are not worth the paper they're written on, to be fair. So if you have a tracker mortgage that has an endowment and you've been on interest only, you're planning for the endowment to pay it down, and you have a large lump sum, I'd be getting very concerned and really talking to the bank that sold you the product that are still around and getting some financial planning advice. Hi, Paul. Paul, you're talking about illness benefit, which I'm on for 9 months, and yes, barely covers living costs. I'm a single mother with 2 kids. Very sorry to hear that. Setting up to become self-employed. Congrats. I've had a horrible 2023 and gone to a lot of arrears and debt. Had to revert to MABs and SVP. Please tell me more about income protection. So, Jorge, I'm not sure why you're on illness benefit, but to have an income protection policy, you get underwritten by the life insurance company. So you genuinely need a good, clean bill of health. Or if you have any medical complaints, to be over those medical complaints. So it's probably something you need in the future. But thanks for sharing that story. It's a testament that everybody that's on this, that why you need income protection, because you know if you had income protection in place, you probably wouldn't have had that hardship, I suppose. So I'm really sorry to hear you went through that, and thanks for sharing it. Hi, Paul. Will the deck or any graphics be shared after the presentation? I think if everyone's email is in, yeah, I think on post our plan to distribute some of the stuff out to you guys, including the financial wheel and the saving charts, etc. Again, that's right. I'm not trying to be smart here with the book. It's 15 or 16 quid. But if you were interested in all those, they are all covered in the book as well, and way more depth of a context point of view. Um, Okay, is this recorded? I missed the first 20. No, it's not. It is recorded. Nothing is being distributed. I think they're going to use snippets for this, guys. I'm a high rate, or maybe I'm wrong. We'll let you know in the email, or I'll post to let you know in the email. I'm a high rate taxpayer who wants to increase by 250 quid. How much would this cost me after tax? Okay, so it's just it's been a long day, so I'm actually gone. I don't usually have a calculator for the simple math, but it's going to be 40%. So if you put in, especially a company pension plan, minus 40%, I'm going to kick myself when I see this answer. Yeah, 100 quid is relief. So you're going to cost you €150. Of course, it's 25. By four, anyway, €100 relief. So you're only going to be missing 150 out of your wages if you increase it by 250. So yeah, hope that helps. Paul, great info. Thank you. Thank you for the comment. What's the name of the Irish life fund you're investing in? So it's not an Irish life fund, it's a Zurich fund. It's called a dynamic fund. If you want to get invested, we do a free financial planning consultations and investment consultation at the moment. So give us a shout. Great info. You're welcome. Thank you. Can I get a mortgage consultation with yourself? You can book in through the link. If you Then we have a really good team of mortgage underwriters that are really slick. So I know all the mortgage stuff. I can do a mortgage consultation, no problem. But if there's any type of mortgage, you know, case to be made, the underwriters will do it for you. So we have underwriters doing the consultations rather than salespeople doing them. To be fair, and you can put in the request. If I'm around, I'll happily jump in with the call. And there's a lot of your money tracking advice requires that most expenditure be made via the card or direct debits online. Can you advise how to track spending if you use more than cash on that card? Okay, so using cash, sign up to askpaul.ie to that finance planner. That will allow you to track your cash, but you have to do it manually then every month, which is fine. Where the on post money manager will just do it automatically. A bit overwhelming. Sarah, you're right. That was very overwhelming. And this is the problem with these things that I'm trying to do so much content in a very short period of time to give as much as I can. So I'm sorry if it was. Hopefully, it is going to be redistributed to recording. You can watch it back and slow it down for yourself. But I do apologize. It happens all the time. I really want to try and get the best advice across and give everybody as much as I can in 45 minutes to an hour. But it's obviously quite difficult because there's so much to discuss. So yeah, I hope that, I hope that helps. The book will definitely help you. You just said you're going to grab a copy of the book. That will definitely, you can read that in your own time and you won't have me at 100 miles an hour. Maybe you will in your head. But yeah, thanks for saying you're going to pick up the book as well. I hope you really enjoy it. Can you recommend an environmental sustainable investment fund? Thanks. There's loads out there in the marketplace, but very careful of what you're looking for here. You're looking for what's called an ESG fund. I invest in ESG with Standard Life. It's called the Global Impact Fund. If you want to give us a shout, we can get you into it. I hope that helps. On post, how much is a consultation? So I'm not sure. Don't do on post. Don't do consultations. But if you want the financial planning consultation with us, they're free at the moment. So jump onto my Instagram page or my website, askpaul.ie. With a large team of consultants there, and you pick what consultant you're looking for, as in what financial planning, investing, pensions, mortgage, etc. Does your book have the audible version? Not yet. I'm going in to record the audio, I think, in a couple of weeks' time, but I will be announcing that on my Instagram when it comes. And I promise I won't speak this fast on the audio. What would you suggest for children? Is credit union best option? No. In fairness, sorry, for kids savings, for children saving themselves, yes. If you're saving for your kids with the children's allowance being recycled, I think you should be investing that money because most people don't access it until they're 18. And you're probably kids under 13 or 10 years of age. You should be investing it. What's your consultation fee for the financial planning? It's like I said, it's currently free on our Instagram page or on our website. Keep saying Instagram page on our website, so go check it out. And yeah, book in. Andrew, hope that helps. We do have a €100 fee on our mortgage consultations. To be fair, so just to say that I'm not trying to mislead, the financial planning is free. Okay, 40 or 20% tax back. I was initially confused by this, thinking the tax relief at source was only given on the balance past 42. 40% for 50 grand salary, 8 grand is taxed at 40%. So how will you be able to claim 40% on the entire amount? You're right. It's only the amount above 40,000. So if you're earning 50,000, you're going to get the marginal 40% on that. Didn't mean to be misleading that. So maybe I did. So yeah, it's only above it's only the portion above the higher rate of income tax. You've explained it exactly as it is in your example. I was just saying when you go over 40% or the higher rate of income tax, you do get 40% for every €100. But yeah, I probably should have said on the income that's above 40k, anything below it. So for everyone to give that example, if you're on 55,000 euro, 50,000 euro, 42,000 the lower rate of income tax, 8,000 the higher rate tax. If you're putting 10,000 euro into the pension, 8,000 you're going to get 40% relief on, and 2,000 falls in under 42. You're going to have 20% relief on that. Wasn't trying to be misleading, so apologies if it did come across that way. Age 53, how much should I be putting into your pension? It's really hard to tell, actually. Sorry, it's impossible to tell without knowing you and knowing your income and knowing your outgoings and whether you have a mortgage or a kid still or anyone living in the house. So what I would be saying is you should be really doubling down on pension at 53 if you want to get out before 60 or 65. If you're planning to work till 70, you've still got 17 years, you'd be a little bit less maybe concerned or worried. Not worried or concerned is the wrong word, on your mind. So yeah, I would, yeah, probably again grab a consultation, whether it's with us or somebody else, and have a good chat about where you are and what you're looking to do. Okay. What do you think about the new Deutsche Digital Bank launched in Ireland? Bunk also has an Irish IBAN. Yeah. So I have a Bunk account, but I've never used it, to be fair. Um, I I suppose I have an N26 account, which is German. I've always used the N26 account. They all do pretty much the same thing. So I'm used to Revolut and N26. So yeah, that's fine. I don't use it though, so I can't read. But I did download it back in the day, but it's just sitting on my phone. I never use it. Would you stick in a tracker or switch to a fixed or variable? Okay, on a tracker rate, you need to find out from the bank what your margin is. If your margin is, 0.75 or 1% or lower, you might keep it. If it's over 1%, 1.5, 1.75, you should probably switch. Uh, that'd be the best thing. Um, yeah, next question is really good. Paul, my 10-year-old has a settlement sitting in the courthouse for the last 4 years. Was any way of removing it and invested for it? No, there's not. What they do in the court cases is when they're looking at the claim, they actually take into consideration future inflation and what would have been achieved, and they kind of snowball it into a lump sum payment. So you don't really have to worry about it. Okay, it'd be great to get access to an investor in fairness for her. But or him, of course, I didn't say. So yeah, you can't unfortunately access it, and I hope everything's okay with your 10-year-old if there was a settlement for something. We have a very low fixed rate on our mortgage, 2.55, rate, 15 years. Should we pay it off? No, I wouldn't pay off as much. No, I would invest. You've got a really low rate of 2.5. I think if you invest that money, over 10 to 15 years, you could possibly, with a right index, right equity fund, maybe get maybe 6 to 8% if you're lucky. You know, and then that lump sum, you can decide what to do with it in 22 years or 15 years' time. You might want to clear off the mortgage, or you might think the mortgage is pittance by then and use that money to buy a second property or put an extension on or do something with it. The problem with overpaying the mortgage, I think it's a good idea if your interest rate's really high, yours is really low, is that you're giving back the bank the money a little bit too early. And again, you're back to the balance in financial planning where you want to have access to cash. You don't want to give the bank the money too quick and then look for a car loan at 8% 3 years' time. So, yes, it's a good idea sometimes to overpay a mortgage, but a 2.55, that's a phenomenal fixed rate, by the way. Is that the Finance Ireland one we mentioned earlier on? Um, Pension, property or pension, would it best just to focus on the paying off the mortgage first and max out for 40 to 50? No, don't do that, because the compound interest now before you get the 40, you're going to miss out. So you need the pension at the long time now. What I would do is max out the pension and then buy a property in the pension in the future. So you can buy a property in your pension fund. It's really cool. There's loads of different rules and regulations around it. Give us a shout for more advice on it. But you can buy a pension property and the income that comes in from the tenant isn't taxed because in a pension, it's really cool. Um, okay. Okay, so this is really, I love this question. Apologies if answered already. I was trying to put a toddler to bed. Do you have to pay tax on the value of the investment, even if you haven't taken out the money? Yes, it's called the gross roll up. So on the 8 year anniversary, they will go in and take 41% out of the revenue. So it's on the 8 years. So just to be careful on that. Guys, I'm really sorry. We're just up to the hour. I'm really sorry that I haven't got seen so many questions coming in. I could probably sit here till 11 o'clock or 12 o'clock with the questions that have come in. If I haven't got to your question, would you please email at the questions at askpaul.ie and myself and the team. Please just put in on post in the subject line, and myself and the team will prioritize it for you over the next couple of days. I hope you've got value out of today, and thanks for jumping on. I know it is that time of kids and bedtime, etc. My own two little nippers, we 4 kids, but the youngest two are up in bed and going to do baby duty now with a 7 month old. So look, I would just like to say thanks to On Post for having me. It's always a pleasure working with On Post. It's very rarely you get to work with a company in personal finance or in the insurance banking sector in Ireland that does have customers really at the forefront. And I can promise you that's what On Post are all about, which is why we like working with them. And we've never worked with anybody in all the years we've been offered loads of different checks and loads of different opportunities, and we said no to them all. So On Post is the first one we've ever said yes to, and I'm proud to do that. So thanks to On Post for having me, and we hope we've added value. And again, I'm sorry I didn't get your question, but please send it through to questions at askpaul.ie. And like I said, head to the website. And yeah, if you think today was good, maybe pick up a copy of that book, Money Made Easy, as well. Cheers, guys. Have a great day.